All right, so let's jump right in. Today we're tackling a question that, trips up a lot of investors in the Taiwanese market. You've got these two powerhouse ETFs, 0050 and 006208. Now, they both track the exact same index, so you'd think choosing between them would be a no-brainer, right? But as we're about to find out, the real story is buried in the details. So how do you actually make the call? Let's dive in and figure it out.
Okay, so to get to the bottom of this, we're going to break it down into 5 key parts. First, we'll look at why they seem so identical on the surface. Then, we'll really dig into the nitty-gritty, the differences in fees and how precisely they do their job. After that, we'll talk about a kind of different way to think about diversification. Then comes the big one. We'll untangle the whole tax situation. And finally, we'll pull it all together so you can figure out the right strategy for you.
All right, first things first. Let's talk about the common ground. It's super important to get why these two funds are so often just lumped together as being the same thing. I like to think of them as two different world-class conductors, but they're leading the exact same orchestra.
So the main reason they seem the same is, well, it's pretty simple. Both ETFs are built to do the exact same job. Their whole purpose is to mirror the performance of the Taiwan 50 index. And they do this using what's called a full replication strategy. All that really means is they try to own all 50 of the biggest companies in Taiwan in the exact same percentages as the index itself. Simple as that. So what does that actually mean for an investor? It means their goal is identical. Since they're holding the same basket of stocks, your TSMCs, your MediaTeks, all the big names, and they have the same mission, if you look at their long-term performance history, it's almost impossible to tell them apart. They're both just trying to capture the growth of Taiwan's biggest and best companies.
And that brings us to the real question, doesn't it? If they're so similar at their core, where do the differences actually start to show up? Where do these two paths begin to split? For anyone who's really paying attention, this is where it starts to get good.
So the first cracks in this whole "they're the same" idea, they pop up in 2 main areas: cost and accuracy. And these might seem like small details, but believe me, over a long investing journey, they can really, really add up. What's really interesting here is that the fee difference is all about size. See, both funds have this tiered fee system, which is kind of like a bulk discount. The more money a fund manages, the lower the fee gets for everyone. And since 0050 is the original giant, we're talking over 600 billion new Taiwan dollars in assets. It's currently in a cheaper fee bracket. And that's where that slight cost advantage comes from right now.
But wait, here's the plot twist. That fee advantage, it's not permanent, not at all. If both of these funds keep growing like they have been and they hit that top tier level, that's over 1 trillion new Taiwan dollars, their fee structures are actually designed to become identical. They'll both end up charging this incredibly low total fee of just 0.075%. So yeah, that whole cost advantage that 0050 has right now, it could completely disappear. Okay, so beyond just the cost, there's the question of precision. This is measured by something called tracking error. All that is a measure of how well an ETF is doing its one and only job. The goal is to have the tiniest error possible. Think of it like you're trying to trace someone's footsteps in the sand perfectly, without any wobbles or straying off the path. And this is where we see a really subtle but pretty consistent difference. When you look back at the historical data, 006208 has, year after year, shown a slightly tighter tracking error. Now the difference is super small. We're talking maybe just 0.08% in a given year. But the key is that it's been there, consistently over different periods. It kind of suggests that Fubon's fund has a small but steady edge when it comes to being precise. So, okay, let's recap. We've got fees that might become the same in the future, but we've got this small historical difference in precision. This all leads us to a more advanced topic, a totally different way of thinking about what diversification really means.
So does holding both of these ETFs actually diversify anything? I mean, your first instinct is to say no way, right? Holding 2 funds that own the exact same 50 companies, that doesn't spread your risk. You're still all in on Taiwan's big stocks. So what's the point? Is there any benefit at all?
Well, the answer is yes, but you have to shift your thinking a bit. It's something called structural risk diversification. See, you're not diversifying the what. The stocks themselves are identical. You're diversifying the how. the unique ways each fund manager, Yuanta versus Fubon, actually runs the fund day to day, their timings, their strategies, their little operational quirks. And that's where this diversification comes from, these small, behind-the-scenes differences. For example, one manager might rebalance their holdings on a slightly different schedule than the other. They might have different ways of handling the cash from dividends before they pay it out. Even the network of market makers they use for liquidity can be different. So by holding both, you're actually protecting yourself from the tiny risk that one manager's specific way of doing things might, for whatever reason, cause a slight hiccup.
All right, now we get to what is, for a lot of people, probably the single most important difference between these two, especially if you're in a higher tax bracket. This is where we need to dive into the, let's be honest, kind of complex, but absolutely critical world of ETF taxes in Taiwan. So when your ETF pays you a cash distribution, it's not just one big chunk of money. It's actually made up of different things. Part of it might be something called income equalization, which you can basically think of as them just giving you a bit of your own money back so it's not taxed. But the other two pieces are what you really need to pay attention to for your tax return: dividend income and capital gains.
And this, right here, is the absolute key tax difference. The dividend income part, that's code 54C, is fully taxable. It gets lumped with your other income and you pay tax on it. But the capital gains part, that's code 76W, is currently tax exempt here in Taiwan. That is a huge difference. The mix of these two in your payout directly decides how much you actually get to keep after taxes. So what's the recent trend been? Well, lately 0050 has been paying out a bigger chunk of its distribution as those tax-exempt capital gains. At the same time, 006208 has been paying out more as the taxable dividend income. So right now, that makes 0050 look a lot more tax-friendly, especially for high-income folks. But, and this is the most important warning I can give you, this is not set in stone. These percentages are dynamic. They can and do change every single year.
Look, the main point here really can't be stressed enough. You absolutely cannot look at last year's tax mix and assume it'll be the same this year. It just doesn't work that way. The mix changes depending on what the fund manager is doing and what's happening in the market. That is why you have to check the official income distribution notice that the fund company puts out before every single payout. That notice is the only thing you can trust. Okay, we've gone deep on fees, on precision, on this idea of structural risk, and on taxes. So, what now? How do we pull all of this together into something useful? In this last part, we're going to do just that. We'll lay out some clear strategies based on everything we've talked about so you can make a choice that actually fits you and your goals. Really, it all boils down to three main approaches. First, you could go all in on 0050. This makes sense if you want the absolute highest liquidity and that current low fee, maybe if you're making big, frequent trades. Second, you could go all in on 00628. This is a great choice if you're more of a regular saver. You like that better tracking record, and you want that lower price per share. And then there's the third way, holding both. If that idea of diversifying away from a single manager's risk resonates with you, this parallel strategy gives you that extra layer of security, diversifying the how. You know, at the end of the day, when you have two funds that are this good, the choice stops being just about the numbers and becomes more about your own personal philosophy as an investor. It really just boils down to one simple question. Are you willing to handle a tiny bit more complexity in exchange for potentially greater peace of mind and operational security? The kind of peace of mind you get from knowing that not all your eggs are in one single manager's basket. How you answer that? Well, that might be the thing that decides it all.